The year 2025 is shaping up to be a pivotal one for the crypto industry. After years of uncertainty and regulatory ambiguity, the landscape is finally shifting. From banking regulations to SEC leadership and stablecoin legislation, significant changes are underway. These changes promise to reshape the industry, bringing both challenges and opportunities. This year's developments represent a departure from the cautious and often unclear regulatory environment of the past. The winds of change are blowing, driven by a confluence of factors. These factors include technological advancements, growing mainstream adoption, and a recognition of the need for clear rules of the road. The stakes are high, with the potential for innovation and economic growth hanging in the balance. The crypto industry has long awaited a more predictable and supportive regulatory framework. These changes signal a potential turning point, offering a glimpse of a future where cryptocurrencies can thrive within a well-defined legal framework. As we delve into the specific regulatory developments, it's crucial to understand the context in which they are unfolding. The crypto industry is no longer a niche sector operating in the shadows. It's a rapidly growing force with the potential to disrupt traditional financial systems. One of the most significant regulatory shifts in 2025 is the reversal of banking pre-approvals for crypto activities. Previously, banks had to navigate a complex and often opaque process to engage with crypto businesses. This requirement created a significant barrier to entry, stifling innovation and limiting the growth of the industry. However, in a welcome move, banking regulators have withdrawn the requirement for pre-approval. This change signals a more open and permissive approach to crypto from financial institutions. Banks can now offer crypto-related services without fear of regulatory backlash. This opens up a world of possibilities for both the crypto industry and consumers. This shift is partly due to the changing political climate and the recognition of crypto's growing importance in the financial system. Lawmakers are beginning to understand that a more balanced approach is needed. This approach should foster innovation while addressing potential risks. The implications of this change are far-reaching. Banks are now better positioned to serve crypto businesses and their customers. This could lead to a surge in new products and services, making it easier for people to buy, sell, and use cryptocurrencies. This increased accessibility could further drive mainstream adoption, pushing crypto further into the mainstream. Another major development in 2025 is the appointment of Paul Atkins as the new SEC chair. Atkins has promised a rational approach to digital asset regulation. This statement has been met with cautious optimism from the crypto community. Atkins's approach is a departure from the previous enforcement-heavy strategy. This approach often created uncertainty and stifled innovation. Instead, he advocates for a more nuanced and principles-based approach. This approach would provide clarity and guidance for businesses operating in the crypto space. A key focus for Atkins is expected to be the classification of cryptocurrencies. This issue has been a source of confusion and debate for years. Atkins's leadership could pave the way for a more consistent and predictable regulatory framework. The industry is closely watching how Atkins's vision translates into concrete policy changes. His tenure at the SEC could be a defining period for the crypto industry. A truly rational approach to regulation could unlock the full potential of blockchain technology, benefiting both businesses and consumers. Stablecoin legislation is a top priority for lawmakers in 2025. As stablecoin use grows, so does the need for clear regulations. Bipartisan bills like the Stable Act and Genius Act are under debate. These bills aim to set rules for issuance, reserves, and consumer protection. Key provisions include pegging to a fixed value and monthly proof of reserves. These measures address stability and transparency concerns. Lawmakers aim to balance regulation and innovation. The outcome will impact the future of stablecoins and financial services. Section 5, the DOJ's evolving stance, what to expect. The Department of Justice, or DOJ, is also expected to make significant changes to its enforcement approach toward digital assets in 2025. While specific details remain scarce, the DOJ's stance is likely to align with the broader shift toward a more supportive regulatory environment. This shift in approach reflects a growing understanding of the complexities of the crypto ecosystem. The DOJ is expected to focus its enforcement efforts on addressing illicit activities such as fraud, money laundering, and market manipulation. This targeted approach would provide greater certainty for legitimate businesses operating in the crypto space. The DOJ's evolving stance is another positive sign for the industry. By focusing on bad actors and working collaboratively with industry stakeholders, the DOJ can play a constructive role in fostering a thriving and responsible crypto ecosystem. Section 6. Trump's Crypto Vision, Executive Orders, and Bitcoin Reserves. Former President Donald Trump's return to the White House in 2024 marked a turning point for crypto in the United States. Trump, known for his unconventional approach, has long been a vocal advocate for cryptocurrencies. His administration quickly implemented pro-crypto policies, signaling a shift in the regulatory landscape. One significant move was Trump's executive order declaring crypto a national priority. This order directed federal agencies to prioritize cryptocurrency development and adoption. Trump also announced the establishment of a strategic Bitcoin reserve. Funded by seized cryptocurrencies, this reserve aims to secure the country's economic interests. Other countries are closely watching to see how these policies play out. Trump's crypto gamble could solidify the U.S. as a digital economy leader or backfire spectacularly. Section 7. Global Trends, from Asset Tokenization to Stablecoin Scrutiny. The regulatory shifts in the United States are part of a broader global trend toward greater clarity and oversight in the crypto space. Asset tokenization, the process of representing real-world assets like stocks, bonds, and real estate on a blockchain, is gaining momentum worldwide. This technology has the potential to revolutionize traditional finance by increasing efficiency, transparency, and accessibility. The Asia-Pacific region is leading the charge in asset tokenization, with countries like Singapore and Hong Kong implementing supportive regulatory frameworks. More countries are expected to follow suit in 2025, launching regulatory sandboxes to encourage innovation and attract investment in this burgeoning sector. Meanwhile, stablecoins are facing increased scrutiny from regulators worldwide. While stablecoins offer numerous benefits, including faster and cheaper cross-border payments, they also pose potential risks to financial stability and monetary policy. Regulators are particularly concerned about the use of stablecoins for sanctions evasion and money laundering. In response to these concerns, the Financial Action Task Force, the Global Money Laundering and Terrorist Financing Watchdog, has issued updated guidance for virtual asset service providers, including stablecoin issuers. These guidelines emphasize the need for enhanced customer due diligence, transaction monitoring, and suspicious activity reporting. Section 8. Navigating the New Frontier Implications for the Industry. The evolving regulatory landscape presents both challenges and opportunities for crypto businesses. Companies must adapt to these changes by prioritizing compliance, risk management, and proactive engagement with regulators. Those that fail to do so risk facing fines, legal action, and reputational damage. The reversal of SAB 121, which previously discouraged banks from holding crypto assets, has opened up new avenues for innovation. Banks and other financial institutions are now better positioned to custody digital assets, provide lending and borrowing services, and develop new crypto-related products. This increased institutional involvement is expected to drive further growth and maturity in the crypto market. However, with greater regulatory clarity comes greater responsibility. Crypto businesses must now navigate a more complex and demanding regulatory environment. This requires investing in compliance expertise, strengthening internal controls, and fostering a culture of compliance throughout the organization. Section 9. A Call to Action, Shaping the Future of Crypto. The year 2025 marks a turning point for the crypto industry. The regulatory fog is lifting, replaced by a more defined and predictable landscape. While challenges remain, the opportunities for innovation and growth have never been greater. The crypto industry must seize this moment to demonstrate its commitment to compliance, transparency, and consumer protection. By working collaboratively with regulators and embracing a proactive approach to compliance, the industry can shape a regulatory environment that fosters innovation while mitigating risks. The future of crypto is bright, but it will require a concerted effort from all stakeholders to ensure its long-term success. By embracing regulation as an opportunity for growth and maturation, the crypto industry can unlock its full potential and revolutionize the global financial system.